A single stamped coin from ancient Lydia changed the world, transforming gold and silver from glittering curiosities into money that built empires, toppled governments, and sparked enduring mysteries like the locked vaults at Fort Knox. Yet in a world where fiat money is barely half a century old, central banks are quietly rewriting the rules again. Could the next shock reshape everything you thought you knew about wealth? The answers start where history and finance collide. In the shadow of the Anatolian mountains, around 630 BCE, merchants in the Lydian capital of Sardis began exchanging something new: small stamped lumps of metal. These were not just shiny curiosities from the Pactolus River. They were the world's first coin, forged from electrum, a natural alloy blending gold and silver in unpredictable measure. Each piece bore a punch mark, or soon after, the unmistakable lion's head of the Lydian kings, a royal guarantee of weight and value that no scale or touchstone could fake. Archaeological teams led by George Hanfmann in the 1960s uncovered hundreds of these coins in the ruins of Sardis. Some were dime-sized, each worth about a month's pay for an ordinary worker. The earliest were simple, irregular blobs stamped with geometric punches. Later, the lion's head appeared, signaling the authority of King Aliates and his successors. Metallurgical assays reveal their alloy ranged from 55 to 90% gold, with the rest silver and a trace of copper. The mix was never quite the same from coin to coin, a problem for trust, but less so when the king's emblem stood behind each piece. The Pactolus gold was legendary, but the real innovation was the stamp. It transformed a risky barter into a contract. A merchant no longer had to guess the metal's purity or haggle over its weight. The royal mark made each coin a promise, backed by the state. For the first time, money itself was standardized, portable, and durable, qualities that let it travel from Lydia's markets to distant ports across the Mediterranean. The royal refinery at Sardis even experimented with separating gold from silver, a process refined further by King Croesus a few decades later. But it was these first stamped coins, born of river gold, royal authority, and the need for trust, that set the template for every currency to come. The world's first coin was more than a tool for trade. It was the beginning of money as we know it. By the late 19th century, gold had become more than a symbol of wealth or a merchant's tool. It was the backbone of a global financial order. The classical gold standard, adopted between the 1870s and 1914, set the rules for nations from London to New York. Every major currency was tied to a specific weight of gold, and that promise was written into law. In Britain, a pound sterling was fixed at 7.32 grams of gold. In the United States, the dollar meant 23.22 grains of pure gold. This convertibility was not simply a slogan, it was a contract. Anyone holding a banknote could walk into a central bank and exchange it for gold at the posted rate. This fixed parity system brought discipline. Governments and central banks could not print money at will. If a country imported more than it exported, gold would flow out to settle the difference. As gold reserves shrank, so did the supply of money and credit. Interest rates would rise, borrowing would slow, and prices would fall, restoring balance through a kind of automatic brake. The rules were clear, and the mechanism was simple enough to be enforced by the weight of a coin or a bar. Central banks became the referees of this system. The Bank of England, the Banque de France, the Reichsbank, and the Federal Reserve all held gold in their vaults, ready to defend their currency's value. Their actions were watched by traders and rivals alike, and a sudden outflow of gold could spark panic or force a government to tighten its belt. Gold moved across borders in steamers and rail cars, tracked to the gram. In 1913 alone, over 700 tons of gold changed hands between central banks to settle trade imbalances and currency claims. But the system had limits. When the pressures of war arrived in 1914, the discipline of gold gave way to necessity. Nations suspended convertibility, hoarded gold, and turned to paper promises. For nearly half a century, though, the gold standard's rules had kept the world's money honest, until the strains of conflict proved stronger than the weight of metal. Granite walls rise from the Kentucky earth, their purpose hidden behind steel and secrecy. In 1936, as the world reeled from depression and the collapse of the gold standard, the United States Treasury broke ground on a new kind of fortress, one built not for soldiers, but for gold. The United States Bullion Depository at Fort Knox was designed to withstand anything. Vault doors each weighed 22 tons. Layers of concrete and steel surrounded the structure, and the perimeter was patrolled by the Mint Police. No outsider would ever know the true depth of its defenses. The first shipments began in January 1937. Over 6 months, a procession of 48 trains and armored trucks moved nearly 500,000 gold bars from the New York Fed and the Philadelphia Mint to the Kentucky stronghold. Each convoy was planned in silence, guarded by Treasury agents and soldiers armed for war. Declassified manifests show every route was mapped to avoid prying eyes, with diversions staged to confuse would-be thieves. One winter night, a train nearly derailed in a Pennsylvania blizzard, but the gold arrived untouched. Not a single bar was lost. Inside, the gold was stacked deep beneath the ground, 4,583 tons at its peak, enough to buy every share on the New York Stock Exchange in 1937. Even the workers who handled the bars never saw the full hoard at once. Layers of protocol kept the secret sealed. The Mint Police rotated shifts, Treasury officials signed off on every movement, and the vault doors closed with a finality that left even Congress guessing. Fort Knox became more than a vault. It was a symbol of American power and a riddle that no outsider could solve. A single breach at Fort Knox would send shockwaves far beyond Kentucky. In the first hour, gold prices would leap. Analysts estimate a 50% spike within minutes, as traders scramble for physical metal. Futures exchanges in New York and London would likely halt trading, triggering limit-up suspensions as market makers face unfillable delivery requests. ETF providers, unable to source enough physical bars, would freeze redemptions. The price of paper gold would disconnect from the spot market, with premiums for actual bullion climbing by the hour. Banks that rely on gold as collateral would face a sudden squeeze. Repo markets, which depend on the certainty of those bars, could seize up, freezing billions in short-term loans. The U.S. Treasury by statute would owe compensation at the book value, about $42 an ounce, while the world price soars above $3,000. Lawsuits would erupt over ownership and insurance claims, and legal precedent would offer little guidance at this scale. Central banks holding dollars as reserves would question the credibility of the U.S. financial system. Some might dump treasury bonds and seek safety in euros, francs, or cryptocurrencies. The International Monetary Fund would be forced to rebalance special drawing rights as gold's share of global reserves becomes uncertain overnight. For ordinary investors, the lesson would be blunt. Paper claims are only as good as the metal behind them. In a true crisis, physical possession, not promises, determines who holds real wealth. On August 15, 1971, President Richard Nixon addressed the nation from the Oval Office. In a measured voice, he announced that the United States would suspend the convertibility of the dollar into gold. Until that moment, every dollar in circulation around the world was backed by the promise that it could be exchanged for a fixed amount of gold, $35 an ounce, held in the vaults of Fort Knox and the Federal Reserve. Nixon's decision shattered that link in a single stroke. The gold window, as it was known, slammed shut. Markets reacted with confusion and disbelief. Within days, the price of gold broke free from its anchor, surging past $40 an ounce for the first time. By 1973, it had more than doubled. The dollar, once as good as gold, now floated on the world's currency markets with no metal behind it. This was no mere policy tweak. For the first time in modern history, money itself was untethered from any physical reserve. The era of fiat currency had begun, an experiment whose consequences would ripple through every financial market, every central bank, and every investor's portfolio. Without gold as a constraint, governments could print money at will, fueling both economic booms and the inflationary storms that followed. The secrecy of Fort Knox, once a guarantee, became a symbol of a system running on trust alone. The world had entered a new monetary age, one where volatility and uncertainty would become the norm. Gold's rise in 2025 did not follow a straight line. It shot nearly vertical, breaking records and expectations at every turn. By late December, spot prices hovered above $4,500 an ounce, up more than 80% from just 2 years earlier. Silver, never content to play second fiddle, surged past $79, then $115 by early 2026. Behind the headlines, the world's debt load pressed higher than ever, with sovereign, corporate, and household obligations topping $330 trillion worldwide, over 3.5 times global GDP. Central banks, once content to watch from the sidelines, became the biggest buyers on the market, adding more than 1,200 tons of gold in a single year. For some, it looked like fortress building against a storm of currency risk and geopolitical tension. Mine supply, meanwhile, could not keep up. Years of underinvestment and stricter regulations left gold output flat, while silver production lagged behind industrial demand. The squeeze was visible in every price chart and every central banker's speech. Some analysts blamed speculative trading or technical short squeezes, but the numbers pointed to something deeper, a system straining under its own weight. As demand for physical metal outpaced new supply, cracks appeared in the market plumbing, deliveries were delayed, premiums spiked, and questions swirled about who really owned what. For investors and historians alike, the lesson was clear. The forces driving gold and silver higher were structural, not just cyclical. The story of money was entering a new chapter, written in numbers that could not be ignored. Ownership of gold and silver is not as simple as holding a bar in a safe. In today's markets, most claims to bullion exist only on paper, layered through banks, brokers, and funds. At the core, there is a sharp divide: allocated versus unallocated. Allocated means each bar or coin is specifically set aside, with serial numbers and weights matched to the owner. If the custodian fails, those bars are yours, not just a line on a balance sheet. Unallocated, by contrast, is a pooled promise. The bank owes you metal, but your claim is unsecured, no specific bar, just a liability on the institution's books. This is how most large exchange-traded funds and futures contracts operate. London's bullion banks run a system where a single bar can underpin dozens, sometimes even 100 separate claims at once. Exchange rulebooks quietly allow for rehypothecation, creating a notional market where paper gold and silver can outnumber physical bars by a factor of 100 to 1. In calm times, the system hums along, but in a crisis, those layers matter. If everyone asks for delivery at once, only a fraction can be satisfied. The rest hold promises. For anyone seeking true protection, the form of ownership, allocated, unallocated, or just paper, defines whether you own metal or only the hope of it. The plumbing of the gold and silver market is invisible until stress reveals its weak points. Every gold and silver bull market is built on a foundation of risk, and the same is true for the bear case. Macro strategists track the levers that can flip sentiment overnight. A surprise rate hike from a major central bank can trigger a rapid unwind, as higher yields draw capital away from metals. In 2026, a single 50 basis point increase from the Federal Reserve erased nearly $400 from gold's spot price in 2 days. Liquidity shocks like a sudden freeze in repo markets or a wave of forced exchange-traded fund redemptions can force large holders to sell, amplifying corrections. On the other hand, policy pivots toward quantitative easing, especially in response to debt crises, have repeatedly reignited demand. When Japan launched its emergency stimulus in late 2025, gold jumped $250 in a single session. Geopolitical tensions such as sanctions or military escalations add another layer, often driving safe haven flows regardless of fundamentals. For every bull run, there is a set of triggers that can reverse it. For every correction, there are mechanisms ready to spark the next rally. Investors and historians alike watch these signals, a checklist of risks and catalysts that define the dual path of precious metals in modern markets. Behind the headlines, the true scale of gold and silver ownership remains hidden in plain sight. Beyond central banks and sovereign vaults, vast quantities of bullion rest in the hands of private custodians, giants whose influence rarely makes the news. The world's largest gold ETF, GLD, reports holdings of nearly 900 tons, with its gold stored under lock and key in London vaults managed by HSBC. Across all exchange-traded funds, the combined total approaches 3,000 tons, roughly 1/10 of the world's above-ground gold. These holdings are subject to annual audits and daily reconciliations, with bar lists published for scrutiny. Vault operators in Zurich, Singapore, and New York manage thousands more tons for private clients, hedge funds, and even sovereign wealth funds acting off the books. The details are rarely disclosed. London's bullion banks, acting as both custodians and market makers, obscure the line between allocated and unallocated metal, making it nearly impossible to map true ownership. In this shadow market, a handful of custodians control flows that can move prices globally. Disclosure rules offer only snapshots, and even the most diligent audit leaves questions unanswered. Ownership in the modern era is less about who holds the metal and more about who controls its movement behind closed doors. 3 futures stand before anyone weighing gold and silver today. The first is a slow, secular climb. Prices grind higher over years, fueled by persistent deficits, central bank buying, and the steady erosion of fiat value. Volatility is a companion, but the long arc bends upward, rewarding patient holders who understand that history rarely moves in straight lines. The second path is consolidation. After a parabolic run, prices settle into a range, sometimes for years. Markets digest the excess, policy changes cool the fever, and new buyers wait for clarity. In this world, those who chase the spike may question their convictions, while those holding physical metal sleep a little easier, content with what they own. The third scenario is the classic spike and collapse. A shock, whether policy, discovery, or crisis, triggers a stampede, and prices shoot higher before gravity reasserts itself. Some are left stranded, others take profits. But the lesson is always the same. Ownership form matters most when the tide turns. Each future has its advocates, its skeptics, and its risks. The choice, as always, comes down to how you hold your wealth and what you believe money should be. Ownership matters. Money is a matter of trust. Right now, over $12 trillion in global gold and silver trades rely on digital promises, not physical bars. As debt climbs and trust in fiat wavers, the oldest forms of money confront the newest risks: opacity, leverage, and unseen hands. The future of value may hinge less on what we own and more on what we can truly prove. What do you trust will hold its worth